Good morning, everyone. Happy Friday. It is Friday, September 5th. We are so excited to bring you yet another information-packed, value-adding webinar for Florida manufacturers, courtesy of FloridaMakes. On behalf of the wonderful FloridaMakes webinar champions, I welcome you to today's edition of the webinar series. Welcome, everyone. I see people coming in. So this is Ruth Buchanan. Hello. Yeah, that's me. And I am very fortunate to be the host and co-producer of this wonderful outreach that we have for you. And I know we have folks from other states as well. Well, welcome. We don't mind sharing this resource to you. So thank you for joining us. Next slide, please. Today, I'm sorry, the topic will be on the tax benefits and incentives, impacts for manufacturers. We all have heard about this big, beautiful bill that passed in July, and we are very excited to be bringing this topic to you, focusing on manufacturers. And today I am joined by my colleague, really the best co-host for this topic. I'm so glad that Rob is able to join me today. He is our regional director for the greater Tampa Bay or Gulf Coast region, very knowledgeable in the field of finance and incentives. So he has agreed to co-host this event with me today. And it is my pleasure. Next slide, please. I think we have, okay, FloridaMakes. Yes, our mission is to strengthen and advance Florida's manufacturing economy. We are your Florida Manufacturing Extension Partnership, and our mission here is for Florida to be recognized as a global leader in manufacturing. Very simple, but very powerful statement. And these are 6 bullets that we put here for you to help folks understand, particularly Florida manufacturers, and how we can help you. So we are your objective third party. We have a host of business advisors that do this for a living and they're to hold your hand. They are our manufacturing experts and also the support team. We are all manufacturing experts coming into this field from different angles, and we connect you with resources as well. We have a wide expanse of statewide partners, and we solve problems. We help solve your problems. And so by doing all of that, we are accelerators for growth for the manufacturing industry in the state of Florida. Next slide, please. Today's key takeaways. Okay, a lot of things are going to happen in the next 57 minutes, so pay attention, please. Those are your 6 key bullets. You're going to learn about the accelerated capital recovery, the innovation incentives, profitability, make it more predictable, and then optimizing your financing costs, super important. Also about strategic growth planning. And then, interestingly, navigating global dynamics, because it's also part of this big, beautiful bill. Next slide, please. And so it's my pleasure to also talk about Paul, but then we're going to get Rob first. So Paul is gracious enough to join us today. He's actually traveling. He's in a government building right now doing his good work. He is a senior manager for Rehmann, and he is doing amazing outreach around the state, telling our businesses, particularly manufacturers, all the benefits from the big, beautiful act. So he's senior manager, advisor, and tax credit. A pleasure to work with. So next slide, I think we've got Rob coming on, right, Teresa? All right, Rob, go ahead, please, and facilitate this session for us.
Sure. Thanks, Ruth. Good morning, everyone. Appreciate you taking the time to join us and about, again, the big, beautiful bill and how it's impacting manufacturers. So we're going to have Paul go through this. But in the meantime, if you have questions as we're going through, please put the questions in the chat. I'll be monitoring those questions. Paul, it's going to take, roughly 45 minutes to go through the presentation. And then we'll have a Q&A at the end. So at the bottom of your screen, you'll see the chat. Just put your questions in there as we go along, and I will make sure to answer them. If for some reason we run out of time and we don't get to your questions, I will absolutely make sure to answer them directly to you. With that, I'm going to turn it over to Paul.
Thank you all very much. Let me just share. Okay, wonderful. So good morning. So thank you all for being here today, kind of as we take a look into the One Big Beautiful Act. Sometimes I'll refer to it as OBBB or OB3 for short. This act really was signed into law around July 4th, 2025, representing, what you could say is a sweeping set of tax changes, the most significant since maybe the Tax Cuts and Jobs Act. And so for manufacturers, it's arguably a very favorable tax legislation that we should be taking advantage of. And so the goal really today is to walk through the act in a way that's not only technically accurate, but also practical. So we'll look at what's in the law, why it matters for your operations, what's important, and how can we plan to best capture these benefits. So this presentation is built for, I guess, three audiences. One would be manufacturers who will see immediate opportunities for investment and expansion. The second one would be business advisors and CPAs who need to translate these provisions into strategic strategies for their clients. And then I guess the third would be kind of policy watchers who want to understand the bigger picture impact on competitiveness and jobs. Let's start with the big picture. So the One Big Beautiful Bill carries an estimated 2.8 trillion in tax changes. It makes many of the TCJA provisions permanent, but more importantly, it layers on new incentives specifically designed to reshore and supercharge U.S. manufacturing. So what does this really mean in practice? Really permanent 100% bonus depreciation on equipment. So no more phase outs, no more sunsets. A brand new deduction for qualified production property. So that's manufacturing facilities themselves, which we'll get into in a little bit. The full restoration of domestic R&D expensing, including an opportunity to deduct prior amortized costs. Enhancements to Section 179 expensing, doubling the limits there. Section 199A for expanded manufacturing pass-throughs. And then we even have kind of on the international side, global intangible low tax income. Sometimes you'll hear it referred to as GILTI. It's replaced with net CFC tested income. I don't think there's a name to how to actually pronounce that acronym at the moment. The other one would be Florida derived intangible income, sometimes referred to as FDII, but it now becomes foreign derived deduction eligibility income. Both restructured, but still incentivizing U.S. exports. And again, we'll get into that a little bit later. And as we see expanded workforce credits, childcare, overtime, Trump accounts, all geared towards retaining and attracting employees. So those are kind of the areas in which we're hoping to kind of communicate and cover as it relates to the new bill. So the law doesn't just tweak the system, it really is reshaping the economics of manufacturing in America. What does that mean? So we'll be covering, again, domestic manufacturing. So again, bonus depreciation, Section 179, qualified production property, and R&D. The other piece will be the international tax piece with NCTI and FDDEI and related global reforms. We'll talk a little bit about business operations, right? Interest deductibility, compliance, and state conformity. And the fourth would be around strategic planning. So what to do now, how to phase investments, and how to keep compliant. Lastly, we'll touch upon workforce credits that may seem like fringe benefits, but actually can directly impact competitiveness for manufacturers. So by the end of this, the goal really is walking away with action steps you can take in the next 30 days, 90 days, and within the next year. So let's start with bonus depreciation. Under the old law, let's say if you had $10 million of equipment, you would depreciate it, say, over 7 years, depending on the type of equipment. That would be around 1.4 million in deductions annually, translating to maybe $300,000 in tax savings each year. Now, under OB3, if you get to expense the entire 10 million in 1 year. So that's a $2.1 million immediate tax savings, assuming we're a corporation at the 21% tax rate. So this isn't just a timing difference, it's a cash flow revolution, really. So instead of waiting years to get your tax benefits, you keep more cash in the businesses immediately. And this is something I think we were all familiar with before the Tax Cuts and Jobs Act. So, and the scope is pretty broad. So this would include production machinery and tooling, robotics and say automation systems, computer controlled manufacturing equipment, quality control, environmental systems like air handling, and production areas. So for advisors, I think this means accelerating depreciation schedules, running new net present value models for projects, helping the clients themselves see the cash flow freed up by tax savings that can fund additional expansion or debt reduction. And for the manufacturers on this call, it means rerunning the math on projects you've shelved in the past. Now, here's one of the revolutionary pieces as part of that bill. It's the Qualified Production Property, or QPP. So historically, you would depreciate manufacturing buildings over 39 years. But slow, and it makes new facilities hard to adjust. Some facilities or some companies haven't even been in existence for 39 years. So the OB3 changes that. Excuse me. It lets you immediately deduct 100% of the cost of new manufacturing facilities if construction begins after January 19th, 2025, and before January 1st, 2029. It's placed in service, so different than when construction begins, before 2031. It's used as an integral part of manufacturing or refining, and you commit to using it that way for 10 years. Things, though, that would be excluded, and one of them I think will be interesting to you all. So office space excluded, parking lots excluded. R&D labs are actually specifically called out. And the reason for that and creating that distinction is it's really designed for use of manufacturing, production, or refining. And there are other tax benefits that you can take as far as R&D production and what may occur in a lab. So things like careful cost segregation studies will be essential. So I think it's important. Let's look at an example here. So a $50 million new plant, previously yielding a give or take, 1.3 in annual deductions, would now yield a $50 million deduction in 1 year. Again, assuming we're not including those ineligible pieces. So that's a $10.5 million tax savings up front. So you can start to see, right, this is a very impactful benefit that manufacturers can think about as far as, all right, is it worth that expansion? Is it worth that new facility? So the planning implications become massive. It requires this will require elections, documentation, and strategy. So it's not just one of those where, all right, we've got a new building, we can take all of it, right? It's still going to, like many other tax sections, require substantiation, contemporaneous documentation to support these positions. One of those ways a lot of times is through a cost segregation study. It'll become standard for almost every new facility and project. So manufacturers, it changes really. The best way to think about it is your ROI calculus overnight. Projects that were marginal before may now make a compelling sense. Let's move to R&D, or research and experimentation. So credits and incentives is one of the areas that is a specialty for myself. And so in 2022, companies were required to capitalize and amortize US and foreign eligible expenditures, 5 years for US and 15 years for foreign, which were performed in the U.S. So for many of you, this felt like a gut punch, right? We're trying to develop something and somehow we're being penalized for that. And so that was obviously a big impact because you were now capitalizing, adding to taxable income. Yes, you were still getting that permanent tax credit, but because R&D and R&E share a similar but not identical definition, there was kind of a balancing act we were all trying to deal with. It created serious cash flow problems. So imagine if you were spending millions developing a new product or improving a production process. You didn't get to recover that cost immediately, something I think we were all very familiar with and comfortable with prior to 2022. So you had to stretch the deduction out over, again, the 5 or the 15 years, which meant you were effectively loaning the government money while you're trying to pay to fund innovation. So again, if we think about an example here, let's say you invested $5 million in R&D in 2023. Under those amortization rules, you would only get $500,000 as a deduction in year one. That's because the first year is a mid-year convention, so you only get to take 10% of it. And so it's actually, we say 5 years for simplicity, but it's really 6 years because you get the remaining 10% in year six. So that's a tenth of the actual spend in this example. So the other 4.5 million would be deferred. So in cash terms, you are waiting years to get back more than $1 million in tax savings. So for many manufacturers, particularly those in, let's say, capital intense or high tech industries, this would lead to delayed projects, canceled prototypes, or even shifting research offshore. It punished companies driving American competitiveness. So OB3 fixes that. So starting in 2025, if you have domestic R&D, it's once again fully expensable in year one. So if you spend $5 million and it is eligible R&D expenditures, you get to deduct the $5 million. So the tax code is now again rewarding innovation instead of penalizing it. So I think though, let's go one step further here. Let's say, so you're also allowed to deduct unamortized prior costs from 2022 to 2024. And you can kind of do it in two ways. So one is you can take any unamortized costs from 2022 to 2024, all in 25, or you can choose to spread it out over 25 and 26. So depending on your tax posture, whether or not you maybe even have some upcoming acquisitions, this is part of that forecasting and planning tool to see what would be better, all in 25 or spread out over 25 and 26. So that kind of, for some of you all, would mean a windfall deduction. So the reason I say that is because if you were taking 25, you would get the unamortized costs from 22 to 24. You'd also, for any current year 25 R&D expenditures, you get to expense that, and you would still get the R&D tax credit, which is a dollar for dollar savings against a company's tax liability. So who benefits the most from this? I think high tech, advanced manufacturing, but again, the R&D tax credit is much broader than your traditional notions of R&D. So yes, your aerospace companies developing, say, lighter composites or new propulsion systems, but that's kind of low-hanging fruit. Similarly, in the automotive industry, if you're building better batteries or autonomous driving technology, for example, those are also areas where you could see an increase in R&D spend as a result of these benefits. Similar case in medical devices, chemicals and material firms, but also other industries like food and beverage manufacturers, creating shelf-stable products, cleaner labeling, and more efficient packaging systems. You see it with bespoke software systems that maybe if you're a wholesale distribution warehouse and you're creating a unique platform utilizing the cloud, improving latency, performance, real-time analytics, communicating to maybe your franchises, right? That is an industry on its face. You may say, oh, well, that's probably not R&D eligible. But the reality is it's not just what they're doing on a day-to-day basis. You have to kind of look behind the veil and really see what are some of those activities internally that might be affecting, right, the marketplace or their customer base itself. So let's also think about, right, what is the impact for smaller innovators? So businesses with under 31 million in gross receipts have some additional flexibility that, say, companies above 31 million do not. They actually have the ability to amend prior returns or spread the deductions out more strategically. So this means the tool and die shops that experiment with new alloys, the plastic manufacturers testing mold designs, or the electronic suppliers improving a circuit board, all can kind of stand to benefit. So R&D is no longer a compliance question, it's a strategic planning tool. The question to ask is really, what's sitting on your whiteboard? What projects did you delay in 2023 or 2024 because of the amortization rules that made them too expensive? Because now the economics have really flipped. The tax code is saying loud and clear, if you innovate in America, we'll reward you now and not later. And so one of the final points I want to mention about the R&D piece is the timing of the elections matter. So some companies may want to take all of their deductions, take all of their prior deductions in 2025. This may create an NOL position or a net operating loss position for you to shield future profits. Others may want to stretch that out again, like we said, over 2025 and 2026 to avoid maybe whipsawing taxable income. Both approaches can work, but again, it's crucial that we're forecasting and we're planning now and kind of thinking about what are those future impacts. So if you take anything away from kind of the R&D expensing piece here, it's really that it's not just a tax break, right? It's about an innovation to invest boldly in the US, right? So if you've got projects again on hold, if you've got prototypes collecting dust, if you've got process improvements waiting to be funded, kind of this is really the moment where, right, you can reevaluate and say, oh, is this something worth considering or bringing back to the table? Now, let's talk about Section 179 expensing. So, this is another one that I think if you're a manufacturer, you're pretty familiar with. But under the new bill, the limit nearly doubles. So, historically, you were limited to 1.16 million. That has now increased almost doubled to 2.5 million, with a phase out beginning at $4 million. And so both of those figures will now be indexed for inflation, so they will be subject to change. So they will likely rise over time, which is good because essentially that's allowing us kind of a bigger kind of uh, it allows for a greater amount to be included than we historically have. So it's not just something where it's going to say, oh, well, that's not really that significant of a difference. If you're a small or mid-sized manufacturer, it makes the difference between upgrading equipment today versus prototyping until next year. So if you're a shop floor and you need a new CNC machine, or welding station, or updated packaging equipment, these are often in the $1 to $2 million ranges. With Section 179, with those increased limitations, you're now going to be able to write off the full cost of those right away. Again, assuming we're under those thresholds. So really, it's about kind of, unlike bonus depreciation, which is automatically applies to qualifying assets, Section 179 lets you choose which assets to expense and which ones to depreciate over time. So it gives you a little bit more control than, say, bonus does. The other piece is flexibility. So it means very thoughtful tax planning, right? So it's not just on a whim, we're going to do this, we're going to expense this, we're going to, depreciate this. So I think the best way, at least for myself, to kind of understand this is again to give some examples. So if you're a manufacturer and let's say you buy $3 million of new equipment, they could elect Section 179 for the first 2.5 million and then use bonus depreciation for the remaining 500,000. Or if you expect to say you've got higher taxable income next year, they may decide to use bonus depreciation now and preserve Section 179 elections for assets that may be able to be placed in service later. Thirdly, or a third option would be you might selectively expense shorter life assets under 179 while depreciating longer living assets under bonus. So this is where I think it's crucial for advisors and the manufacturers themselves to be in close communication. It plays a crucial role there because Section 179 and bonus depreciation are not either or; they are complementary tools. So the art is in sequencing them. So suppose your client has volatile income, right? So some profitable years, others that are marginal. Section 179 can be dialed up or down depending on taxable income levels, while bonus depreciation is more of like a blunt instrument. So carefully coordinating between elections, you can smooth taxable income across years, prevent losses from going unused, and even maximize tax cash flow impacts. Another thing that I think is important about Section 179 is it does not apply to just traditional machinery and equipment, but also to certain software, improvements to non-residential real property, and specialized fixtures used in production. So this makes it particularly useful for, say, companies that may not be buying heavy machinery, but are still upgrading production capacity. So don't just look at the equipment schedules in isolation. Really sit down with the manufacturer if you're an advisor and ask them, what are you buying this year? What is in the pipeline for next year? Do we coordinate with bonus in 179 or do we stagger them? So again, all just questions to be thinking about as we think about the impact of this new bill. Let's talk about advanced manufacturing credit. So this is kind of one of the more exciting pieces from the bill, especially for high tech and capital investment intensive sectors. And the reason for that is this credit already existed, originally introduced as part of the CHIPS and Science Act to support semiconductor manufacturing. But under the new bill, it gets an even more significant boost. So the credit jumps from 25 to 35% of property placed in service after 2025. So really, I mean, what are we thinking about when we say 25 to 35 jump? What does that really mean? It means that for every dollar you invest in qualifying advanced manufacturing facilities, the federal government is essentially funding more than a third of it through a tax credit. And the industries that qualify are really no accident. I'm sure you hear about this if you're looking at the news. They are strategic technologies for the future. So those would be semiconductors, which power everything from smartphones to fighter jets. It would be battery technologies, so critical for EVs, energy storage, and defense. Critical mineral processing, essential for supply chain independence or rare earth materials. Quantum computing, which you're hearing a lot about, especially with the advancements in AI, for the next frontier of computer power. And then advanced defense materials. I think that's always something the U.S. has been heavily invested in, right? That just kind of further reinforces this from composites to precision alloys. So this is where these are specific industries where you're hearing from the bill, even right, that America must lead. So they are using the tax code to make sure we do. They are providing that foundation for companies to take advantage of it. So one of the things that actually is even more interesting is this credit stacks with bonus depreciation. So again, if we think of about an example, suppose you're building, again, this is just hypothetical, $100 million semiconductor fabrication facility in Florida. Under the new bill, you get to deduct, and again, assuming there's not any ineligible components to this in this example, you would get to deduct potentially the full 100 million in year one through bonus depreciation, resulting in around $20 million in tax savings at the 21% corporate tax rate. On top of that, you would get a $35 million credit under the new 35% rate. Now, I know that's an extreme example, and I don't expect you all to necessarily go out and spend that kind of money. But again, what we're trying to do is just reinforce, right? These are significant benefits that can have significant impacts because in that example, right, you're seeing $56 million in benefit in 1 year. And yes, it was nice to kind of put really big numbers there to really show the gravity of this. But really, the reality is, right, more than half of the cost is covered through your investment. I think that's the real takeaway here. So, from an economics perspective, right, a facility that once maybe took 15 to 20 years to pay back could now break even much faster. So it's no longer just a question of long-term strategy, right? It's immediate near-term ROI. So manufacturers that are on this call, this is a green light to accelerate projects that were maybe on the bubble. If you're considering reshoring production, scaling advanced manufacturing, or expanding into new technologies, the economics just got dramatically better. The advisors on this call, I think this is where modeling is critical. Credits and deductions interact differently depending on the taxable income, existing net operating loss, or even if you're in a carry forward position. So layering in that 35% tax credit on top of the 100% expensing sounds simple, but in practice, and I'm sure any advisor on this call would say, right, it still requires strategic elections and avoiding leaving money on the table. Additionally, the increased 35% credit applies to property placed in service after 2025. So this does create what you could consider maybe some urgency, but also at the same time opportunity. So if you've got a project in the pipeline, you want to make sure that the structure and timeline carefully are kind of being thought through. And the other piece to this that I don't think gets as much of attention as it should is you do not want to overlook the state incentives. So states like Florida, Texas, Arizona are aggressively courting advanced manufacturing. I think that's no shock to anybody on the call here. So stacking federal credits with state grants, property tax abatements, workforce training subsidies really kind of gives you, and I know this is kind of a bullish comment here, but a once in a generation incentive, right, for these types of developments. So it's not just, again, lowering your tax bill. It's reshaping global supply chains. It's driving domestic competitiveness. It's giving U.S. manufacturers a decisive edge. Again, all things that bill is trying to promote. Now, let's talk about Section 163J, interest deductions. And this is kind of more around financing because for manufacturers, growth always, for the most part, comes with debt. So under the prior rules, under this section, it was limited to the amount of business interest you could deduct. And the cap was really set at 30% of EBIT, so earnings before interest and taxes. And one of the reasons this was a problem was manufacturers tend to have heavy depreciation and amortization. So large investments in machinery, tooling, facilities that generate big non-cash deductions, which reduce EBIT and shrink the amount of deductible interest. So the result then is many manufacturers found themselves unable to deduct the full amount of their interest expense. In practical terms, that would mean you'd really be paying interest in cash to your lender, but the tax code told you, well, sorry, you really can't just deduct all of it in 1 year. And this would then impact your effective tax liability, hurt cash flow even more. Well, the new bill fixes this, and it fixes it permanently, or at least as far as permanence goes from a tax legislation package, right? It restores to EBITDA standard, earnings before interest, tax, depreciation, amortization. So by adding back depreciation and amortization, your limit is now higher, right? Which means you can deduct more of your actual interest expenses. So let's put this into numbers again to kind of show or quantify this. Suppose your company has, and again, these are larger numbers, but $20 million in gross income, 6 million in depreciation, 20 million in amortization, 4 million in interest expenses. Under the old rules, or EBIT, you'd calculate 30% limit on the 12 million. So the 20 million minus the 6 million minus the 2, which means around 3.6 million of your 4 million interest expense was deductible. That's a $400,000 loss essentially. Under the new rules, under EBITDA standard, you would calculate the limit on the $20 million, adding back depreciation and amortization. So now the cap is 6 million, which means your full 4 million interest expense is deductible. That's now on the 180 degrees shift, right? That's a $400,000 in tax savings just from this rule change. So for many capital intensive industries, so that would be your automotive suppliers, your aerospace manufacturers, precision machining, metal fabrication, construction related manufacturing, this really is kind of a game changer, right? The other piece is kind of this floor planning financing exception that has been expanded. So originally it applied to primarily auto dealerships. Now it extends to industries like trailers, RVs, heavy equipment, and other sectors that rely on financing large inventories. So this is particularly important in the state of Florida, where logistics, equipment manufacturing, transport services are major players. So if you're a manufacturer, it means that the tax code is now friendlier to debt finance growth, essentially. So you can take on financing for expansion projects, plant upgrades, or new equipment without even having to worry about the interest deductions that will be artificially capped. So if you're an advisor, right, what this means is it's time to review your client's debt structures. Sometimes the client, some companies might have previously avoided leverage for tax reasons, but maybe now is the time to rethink that, or at least look into it. Others may benefit from refinancing existing debt, since more of the interest is now deductible. And again, this is also a planning opportunity, again, to kind of get the manufacturers and the advisors on the same page. The shift to EBITDA means that companies should revisit their capital structure models. So in the past, the tax code was penalizing debt-heavy financing and manufacturing, but now it's kind of flipped it on its head. So it recognizes that manufacturing requires long-term investments and makes the system more supportive of those capital needs. So the bottom line, really, if you take anything away from the slide is, right, if you are a capital intensive manufacturer, financing growth has just become more tax efficient, essentially. So let's spend a little bit of time on international. I do think it's important and relevant to some companies on this call. So turning to abroad, GILTI is gone. NCTI is here. And really, again, just to reiterate, and I'm having to get familiar with the name change too, but net CFC tested income. So the Section 250 deduction is set at now 40%. A foreign tax credit haircut is cut from 20% to 10%. And the old deemed tangible tax or deemed tangible income return is eliminated. So the effective minimum tax rate rises to 14%. But for many, the bigger story is fewer disallowed foreign tax credits. So everything I just said, I think the key takeaway, right, is if this is applicable, right, you may now have fewer disallowed foreign tax credits. So for a US manufacturer with, say, overseas subsidiaries, the regime is a bit simpler and arguably now a little bit fairer. Um, but this unmistakable policy does signal that the tax code is rewarding income earned in the US over income earned abroad. Again, something that you are seeing throughout the entire legislation package. Now, let's talk about foreign derived deduction eligibility income, or formerly FDII. The deduction rate was reduced from 37.5 to 33.34%. So but the elimination of QBI and the exclusion of R&D and interest expenses from allocations may actually increase deductions in many cases. So if you are an exporter, this keeps incentives alive. If you're a US manufacturer selling abroad, this now ensures you get a lower tax rate on those export earnings. Now, again, I'm sure lots of things will come up with regarding tariffs, but at least as we think about these tax provisions, right, this is kind of how the mechanics work out. So, from a planning perspective, right, you want to review transfer pricing, export structures, expense allocations. And as advisors talking to their clients, right, this is where the modeling will pay in dividends. Other international things to consider. So Section 958 is reinstated, clarifying controlled foreign corporation ownership. Also, cost sharing agreements face tighter anti-abuse rules, and reporting obligations are heightened. So global operations still remain possible, but the tax code again is trying to favor the production and IP onshore. Now, in addition to just things that you would traditionally think as tax benefits, credits, deductions for companies, there are other benefits in this tax package that I think are important to highlight. Some of those being employee benefits and credits, because really this is now talking about your workforce. So if you ask, and I would imagine many of you all, right, if I ask a manufacturer maybe what keeps them up at night, the answer probably is not taxes, although it is arguably the sexiest topic ever. Or it's not regulations. It's really their people, right? So finding skilled labor, keeping turnover low, building a pipeline of workers who see manufacturing as a long-term career. Right? These are all things I think most manufacturers can agree is something they sometimes struggle with. Well, the new bill kind of recognizes this and enhances several employer credits designed to address this exact change. So the first one I want to talk about is the child care credit. So this rises to 40% of qualified child care costs. And for small businesses, you get even more of a bump. It jumps to 50%. So that's almost a dollar for dollar offset against what you invest in helping your employees manage child care. And even better, if you provide on-site childcare at your manufacturing facility, which, depending on what type of manufacturing could be interesting there, you could qualify for an additional bonus credit. So think about the power of that. So for a worker deciding between two job offers, one with on-site childcare and one without, I think the choice is probably going to be pretty easier. You get happier, more loyal employees, and the government helps you cover the costs. Another one that you may have heard of is the paid family leave credit. So previously this was temporary. It is now permanent, and they enhanced a little bit of it. So the stability matters because employers can now build a family leave into their long-term benefit planning without worrying about, is it going to disappear? That is kind of one of the great advantages of when a code becomes permanent. And again, permanent in the sense of, right, there isn't a new legislative bill that gets passed, but this is about as good as it gets from a tax perspective. And so in a competitive labor market, which I think we can all agree we are in, being able to say, we support you when you need care for your family, I think goes a long way. There's a large imputed benefit in addition to the actual benefit of being able to say that. There's also some additional things that I think are going to be pretty helpful, which would be, say, overtime deductions. So for manufacturers who rely heavily on overtime, whether it's ramping up production lines, covering labor shortages, handling season demand, this is a direct win. So the tax code actually is now giving you explicit deduction for overtime compensation. So this means you don't have to choose between adding headcount you can't find or paying overtime that eats away at your margin. You now get some tax relief. And the next one is kind of Trump accounts. So these allow employees to contribute up to 25,000 or 2,500, I'm sorry, per child into a tax-free dependent care account. So it's just another way, right, to support employees with families, right? It's another touch, right? So it's a way to show your employees, right, you're invested not just in their output, but their lives. The reason I think all of these matter, especially in the aggregate, is because workforce is the number one issue in manufacturing today, or at least I would argue it's at least up there, right? So these provisions aren't just about reducing your tax bill. It's really kind of about helping you attract and keep people you need to run your business. Again, there's competitiveness amongst states too. So this could be the difference between somebody staying at your facility versus going somewhere else. So let's just talk about an example because I think, again, examples are the best way to highlight this. So let's say you are a mid-sized manufacturer, 200,000 employees, and I know that might be a little bit larger, but let's say you decide to set up on-site childcare, costing around, $500,000 a year, or yeah, $500,000 a year. So under the new bill, basically the child care credit could offset around 200,000 of that cost. So 250,000 if you're a eligible small business. You add in the overtime and the Trump accounts, and suddenly your employee benefit program isn't just sustainable. It's a competitive, marketing and recruiting tool for you all. And so for advisors, right, that are listening, right, this is where I think you can add some value. So it's not just telling them about the credits, it's helping them design benefit strategies to take advantage of them. You can ask them things like, right, would on-site childcare make sense given your labor challenges? Maximizing credits for family leave, does that make sense? And you turn overtime into a tax smart tool rather than draining your profits. So again, this is not just rewarding, investments in machinery and buildings. It rewards investments in people as well. And so for manufacturers, this might be one of the more significant and most important levers for long-term success. So just kind of briefly to summarize kind of domestic versus foreign incentives, when you put it all together, right, I think the message is clear, right? Invest in the US. So domestic operations can see their effective tax rates fall to maybe single digits after laying in the bonus depreciation, the QPP, the R&D, the 199A, and any additional credit. You have foreign operations, they will now, whether you like it or not, will face kind of tighter rules, higher effective tax rates, and more compliance. So the industrial policy essentially is changing because of the tax code. And it's not honestly very subtle. It's kind of right in your face. So from a cash flow perspective, right? Let's say you're a medical device company. Again, plans a $775 million facility. Under the old rules, they get around 1.9 depreciation annually. So that's around $400,000 in savings. Under the new bill with QPP, they could potentially, again, assuming there's no ineligible aspects to the 75 million, right, deduct all the 75 million in 1 year. So that would say 15.7 tax savings immediately. So again, it's not just a tax rate, right? You can scale that to what's applicable for your own company. The reality is, right, it's hard to argue, right? You're you extending the life of when you get that benefit back, or can you take it immediately? Right? There's a time value money component to that. So it's changing the economics of the project entirely. I'd be remiss if I didn't mention state tax considerations. So yes, I think you've heard a lot about some of the federal benefits, but not every state plays by the same rules. So one of the challenges when we're thinking about, right, how are we utilizing these federal tax provisions, right, is some states automatically conform to federal tax law. Others adopt conformity on a rolling basis, and some only at a fixed point in time. And still, others pick and choose decoupling from provisions they don't like. So the best example would be that 174 research and experimentation provision, where you had to capitalize and amortize. There ended up being states that decoupled from that, where at a state level, you would not have to capitalize and amortize, even though at a federal level, you still did. So in practice, it means that the new bill offers major federal benefits, but your actual state tax position may look a little bit different or significantly different depending on where you operate. So let's think about bonus depreciation as an example, right? The new bill makes 100% bonus depreciation permanent at the federal level. Many states have not chosen to conform. So that means that you're able to expense that 10 million piece of equipment for federal purposes, but until your state conforms to it, for state purposes, you may be still depreciating it at a slower life, or in the example I used earlier, I think the 7 years. The same is true for the qualified production property provision. Some states may adopt it, others may exclude it. And remember, these can be large numbers because now we're talking about, buildings themselves. So again, that building facility, that's tens of millions of dollars potentially. That's really kind of the difference between full expensing federal and slow depreciation at the state level, which really still can swing your tax bills potentially by tens, hundreds, millions of dollars. Think about Florida, though, right? Well, most of us are located in Florida. Florida is unique because it has no personal income tax. I think a lot of us on this call really do appreciate that. And a corporate code that generally conforms to federal rules, though not always automatically. So, in most cases, though, I would say for Florida manufacturers, they should expect to see these federal benefits flow through. So, bonus depreciation, UPP, R&D expensing. So that's the good news. But in what I think what's also pretty important is multi-state operations can't assume uniformity, right? So if you've got plants, warehouses, sales activities across multiple states, you do need to look at each jurisdiction individually. So for example, right, if you've got states like California, New York, Massachusetts, that often decouple from federal provisions, right, especially those that significantly reduce revenue. So this will create, again, for your advisors, right, major planning and compliance opportunities you want to communicate to your clientele. And so, again, it's not just about calculating the federal deduction tier. It's about modeling the impact across every state where your client operates. You're reconciling book to tax differences. You're planning capital investments for both federal and state outcomes in mind. So again, an example. So suppose you're a Florida-based aerospace manufacturer with a satellite operation in Michigan and California. So federally, your new $20 million plant expansion is fully deductible under QPP. Michigan, you may get conformity. California, you probably will not. Suddenly, your federal tax savings are maximized, but your California apportionment is creating a state drag. So that's where I think proactive planning, cost segregation, entity structuring, or even site selection can create a lot of value. So I think the important piece to take away here is for state conformity, it is not guaranteed. Every manufacturer, I think, needs to run a multi-layered tax analysis, federal plus each state they touch. And for Florida manufacturers, while I do think the Florida landscape looks favorable, don't assume business as usual. It's important to keep an eye on legislative updates because as these federal provisions start reducing state revenues, even states like Florida may feel the pressure to decouple in certain instances. So I think the takeaway here is right. Don't just celebrate the federal win because I think there is a lot to celebrate, but make sure you've got a state playbook in place as well. From a compliance standpoint, um, this is less exciting, I'm sure, for many of you, but it still is critical. I think so for every major benefit, right? It's going to require elections and documentation. Right? So going back to QPP, construction start date, in service dates, right? Those are key parameters one must consider. 10-year usage commitments, R&D, segregating between domestic versus foreign. So U.S. domestic costs can be expensed. If you still have foreign R&E or research and experimentation, you still have to capitalize and amortize that. Again, that's going back to the incentives of onshore development. For bonus depreciation, right? Your place in service records do matter. From an international perspective, transfer pricing and expense allocations. So Form 3115, which is your method change form, will become a common item of discussion potentially in the next couple years. So documentation when you're making those method changes potentially will be a make or break depending on your situation, especially if you're audited. So from an industry perspective, and I know I'm running out of time, so I'll try and kind of speed up these last couple, but I think there's a few industries that could see huge wins. So semiconductors, right? Huge wins from the 35% credit plus the bonus depreciation. Your automotive or your QPP for new plants, and that again could apply to any industry. Overtime deductions, consumer credits. Again, all that would kind of have those manufacturing process improvement facilities. Pharma, biotech, you've got your R&D expensing restored. But again, that's going to be applicable to almost or the majority of manufacturers on this call. Again, a unique one like food processing, agriculture, those are still going to potentially see the advantage of QPP expansions or where you have retail space. And I think, again, especially in Central Florida, where you've got the aerospace and defense, where, or at least with the Space Coast, right, the R&D and the international planning is sometimes pretty significant. So what are some immediate actions in the next 30, 90, next year? So I think talking about accelerating equipment purchases into 2025, reevaluate your facility plans. Think about increasing your domestic R&D spend, review debt structures, and planning for enhanced employee benefits. So again, these are things that start for the most part on January 19th, and that they'll qualify. So again, we're thinking about things that can immediately start to benefit you. Long term, not 30 to 90 days, right? Making sure we're implementing elections carefully. Like again, it's great to say, hey, we're eligible for this, but procedurally, right, you do want to make sure, right, you're crossing your T's, dotting your I's. Use cost segregations to your advantage. Reevaluate international structures if they're applicable. Consider reshoring supply chains. I'm not going to sit here saying tax should dictate business decisions, but being aware of how it can implicate or impact your tax posture, I think, is important. And again, I would say continue to upgrade documentation. So to kind of wrap up, I would start with that. Just last slide real quick. So, kind of to wrap up, the bill is probably, again, one of the most significant pro manufacturing tax legislations in decades. So, again, it permanently lowers the cost of investing in U.S. equipment, facilities, and innovation. So, I think the winners will be those that act early. So, accelerating purchases, breaking new ground on plants, ramping up R&D, structuring employee benefit plans. For the manufacturers, I really do think this is a moment to capitalize on, no pun intended. For advisors, I think this is really our opportunity to kind of guide clients in the next area of competitive advantage, especially with an emphasis in Florida. So the legislation is permanent, but the timelines necessarily are not. So facility windows, elections, deadlines are still baked in. So you don't want to necessarily leave money on the table. That's kind of all I had for today. I do appreciate your all's time. I think I went more
Nope,
over
you're
than
right.
I feel like.
We're right there, Paul. You're good. We still have a few time. We still have some questions. So first of all, Paul, thank you for taking the time out of your day to kind of give your interpretation of this, because there's a lot that goes into it. And I would say there's probably a majority of manufacturers on here that they just don't have a chance to read it. So they're depending on someone like you and someone like FloridaMakes to help them navigate these waters. So great. So there's a couple questions.
Nice Sunday morning reading, I will say that. Come with your coffee to take.
So on the advanced manufacturing credit, how does it compare or different from the ITC or the PTC, the investment tax credit or the production tax credit?
So I think the biggest difference is when we got all these credits and incentives as part of this package, right, they are geared towards more generic activity, meaning manufacturing, production, refining. The ITC and the PTC are energy focused, and those are actually credits that are going to be sunsetting in the near future. That was kind of the large concession to get a lot of these tax breaks, was a lot of those green energy credits, which the ITC for, say, solar, geothermal, would go away. Those were giving significant tax credits back, 30, 40, 50. You might hear 70, but I don't think anybody's ever seen the golden egg there on maximizing that. But this is really broadening the ability for not just solar panels or geothermal, right? It's more about what is being conducted within the facility, right? Opposed to how are you utilizing energy? Are you reducing your utilities themselves?
Right. Great. So are these either sellable or transferable?
Yeah, so these are more geared towards it's your own tax credits. I know the ITC had provisions in certain circumstances where you could sell them. That is not the case for these. These again are trying to keep money in those that invest in it, but not to necessarily sell them. So you are going to see distinctions there between those as far as, all right, if you take the credit, it's more than about can you fully utilize it? And I think that's where timing is a consideration itself.
Okay. No, that's great. So on bonus depreciation, is there a way you can define the assets that qualify? And what are their limitations, if any?
So your tangible property, I think, is the best way to define bonus depreciation. And what I mean by that is there isn't, quite frankly, like an infinite list of what types of property would be bonus eligible. So your software that you could, potentially depreciate over 3 years, that is something, right, that gets 100% bonus. Your office chairs, your materials, right, your equipment themselves, right, that is kind of a plethora of things. Again, think about it as almost everything in the facility or the plant that is not the actual kind of real property or the structure of the plant likely is going to fall in a category eligible for bonus. And that part is not necessarily defined by is it manufacturing or is it not? Like I said, your office chairs, your computers, those are all going to be things that maybe are incident to or indirect for the business that would still be eligible there. Um, Bonus is one of the few where there's less limitations than, say, the credit, where sometimes it is limited to offsetting only around 75% of a company's tax liability.
Great. There's a couple more questions, but for anyone who asked a question we didn't get to answer here, we will definitely email you the information because again, we are coming up to the end here. So for the 179, this question is it's a two-parter. They're going to be expanding their facility, adding square footage. So what can potentially be eligible, and does solar also fall under the 179?
So solar can fall under it. I think that's where we would want to talk through what is best on their tax posture. What are they expecting from taxable income, current year, subsequent year, to interplay between, if they're doing the facility expansion, depending on what is the facility expansion, right? What are the additional personal or tangible personal property that is being included in there? And then kind of what is the solar being geared for? How much is it going to utilize? Because I think that's where, depending on how it's being utilized, what your tax posture is, and the economics of it, it would depend on kind of how we would ultimately treat those assets themselves. So I know that's not a specific answer,
Right.
but I think that's the point, right? They couple each other and they can all work in tandem, but it's just kind of now figuring out what's best for you all to maximize your savings.
Perfect, Paul. And again, I appreciate you taking the time. Again, if there is a deeper dive, that's the time to bring in FloridaMakes. The business advisors are here to help you take a deeper dive into this, and we will bring in experts like Paul to kind of define what you should look at. With that said, we're about to wrap this up. I appreciate everyone taking some time. These are the key takeaways. I do believe we covered most of them in this short period of time. The presentation will be sent out to you. So after about an hour from now, the recording will be available to rewatch also. So we will be covering all these things. There's a QR code on your screen that you can scan and get more information about your local manufacturing associations. There are multiple associations throughout the state that partner with FloridaMakes. our goal here, again, is to help manufacturing. Now, we have a couple events coming up. You can look at our events page on our website, and you can get more details about all the upcoming events. But one of the big ones, or two in-person events, is SESME Roadshow. The Smart Manufacturing Institute is partnering with FloridaMakes to do a roadshow on October 13th in Orlando and then October 14th in Tampa. These are two great events to talk about automation and growing your business. So again, you can go on our website, go to our events page, click on and get more information about this. And last thing I'll bring up is the become a Florida manufacturer employee of choice. So there's an award. You can, again, scan the QR code and get more information about that. And with this said, I'm going to turn it over to Ruth to close us out. Ruth, can't hear you. You're on mute.
Thank you so much, Rob and Paul. Can you hear me now, Rob? Okay. Yeah. So we want to thanks again for your time, Paul. There's so much information in that presentation. We invite you, as Rob said, engage with us. If you want to be connected with Paul, just let us know. Rehmann is happy to support our manufacturers in the state of Florida. I just want to take a few seconds. Make More Manufacturing is coming up. Please register and join us. There is a code, a discount code that we will send to you October 22nd and 23rd. And as Rob said, we have the next webinar is on the 26th to learn about smart manufacturing, and there's 2 roadshows. Anything else on the slide, Patricia? Or okay, so thank you all. We will see you again in a few weeks. Have a good weekend. Bye-bye now.